Hello friends and welcome to StudyIQ. I am Joy and today in this lecture we will discuss about easing of the conditions for angel tax. So recently the central government has decided to ease the conditions for angel taxing or taxing investments in the startups. So we will look into this issue in detail in this lecture and what are the recent decisions of the central government. But before we begin, this is our channel StudyIQ and you can get pen drive courses for various competitive exams including SSC, bank coaching, UPSC Civil Services, NABARD, RBI exams and also for various professional courses and various competitive exams. And also the month-end sale is going on till 28th of February 2019. You can avail a flat 60% discount on all your purchases. You can visit our website www.studyiq.com or you can make a call to any of these numbers for more details. So let us continue with our discussion. Before going on to the decision made by the central government, let us first understand what is meant by an angel tax or an angel investor. So first, who is an angel investor? Angel investor is a person who provides capital for a business startup. So the startup business would definitely be facing a shortage of capital, and an angel investor is an investor who provides capital to the startup business, and this capital would be provided in exchange for a convertible debt or an ownership equity. So this can be in the form of either debt or equity. Equity means that the investor would be getting shares of the company, or convertible debt means that it can be converted into equity in a later stage, or a definite or a fixed rate of interest would be provided for the capital that is provided by the angel investors to the startups. Now, it is understood who is an angel investor. Now, let us understand what is meant by an angel tax. So, angel tax is the tax that is levied on angel investments. Now, we know what is angel investment, and the tax that is levied on an angel investment is called the angel tax. So, this is the tax that is levied on the capital provided for the startups. When an external investor or a person provides capital to startups or new companies, this would be taxed and it is called angel tax. And now coming to the present taxation structure of the angel taxation in India, in certain times, capital raised by the startups, this can be the capital raised by the unlisted companies via issue of shares. So here the share price would be excess of the fair market value. So we need to understand what is fair market value. It means that in certain cases of angel investments, unlisted companies would be issuing shares, and this shares would be issued at a price, that is the share price. The share price would be more than or excess of the fair market value. So fair market value means the normal value of shares in the market. So here we must understand that at the present taxation structure, the entire investment will not be taxed. It will be only the excess amount that is considered to be above the fair market value would be taxed, and this is at the rate of 30%. So hope the idea of fair market value is clear. So any investment or any amount that is excess of fair market value would be charged at a 30% angel tax. And this provision of 30% taxation on the amount excess of fair market value was introduced in the 2012 Union Budget, and this was introduced in order to arrest the laundering of illegal wealth by the means of investments in the shares of unlisted private companies. So the angel investments was used as a route in order to undertake illicit practices like the money laundering. Now, what are the concerns associated with taxation of the angel investments? There are mainly two concerns. First one is regarding the valuation. So we have seen that taxes would be levied on the excess amount that is above the fair market value. Now, what is the criteria that decides fair market value of a company's share? So that valuation was very difficult, and therefore it was difficult to arrive at what amount of investment should be taxed. So that was one major concern. Second one was the vulnerability of the startups. So government is also targeting in order to improve the startup ecosystem in the country and thereby providing various kinds of incentives in the form of rebates, tax concessions, etc. to the startups in India. But at the same time, one major concerns for the startups is the capital requirement, and a majority of the startups would be acquiring capital through angel investments. So with the taxation of the angel investments, it was difficult for the startups to acquire capital also. So along with this is the uncertainty and vulnerability of the startups. The startups undertake innovative business and therefore there is a lot of risk and uncertainty associated with the functioning of startups. So this kind of taxation provided or added to the concerns of the startup business in India. So these were the concerns. Now let us come to the new proposals by the central government. So according to the new proposals of the central government, the aim is to simplify the process of exemptions for startups under section 56 of the Income Tax Act. So the major focus is on simplification of tax procedure. And for this purpose, various amendments or changes have been made by the government. The first one is that in order to be considered as a startup, the date of incorporation would be considered, and an entity will be considered as a startup till 7 years of its incorporation previously. Now government changed the 7 years into 10 years. That means that an entity will be considered as a startup up to 10 years from its date of incorporation. And second condition regarding the turnover of the company, earlier the condition was that the turnover for any financial year since its the turnover for any number of financial years since its incorporation or the registration should not exceed 25 crore. So since the date of incorporation, the turnover should not be more than 25 crore, and if it exceeds 25 crore, it would be not considered as a startup. Now this 25 crore has been enhanced to 100 crore. That means since the day of incorporation, the maximum turnover can be 100 crore in order to be considered as a startup. And thirdly, certain new exemptions are also provided. All investments into eligible startups by the NRIs, that is non-resident Indians, alternate investment funds or the AIF, or any kind of category 1 registered with SEBI will also be exempt under the section 56 of Income Tax Act. So these are the new exemptions added to the startup investment. Now let us understand how does this new proposals benefit the startup ecosystem in India. So we have seen that earlier when government had introduced stringent rules on angel taxation, this had an adverse impact or adverse effect on the investor confidence and also in the startup ecosystem. So these relaxations made by the central government will help in raising the capital by the startups. So proper or adequate availability of capital will help the startups to fund their growth and to make proper investments. So this will help in increasing their productivity, thereby the output. So they will be able to meet their business requirements with adequate capital that is available with the relaxed regulations. And secondly, these new rules are retrospective in nature. That means those companies which were previously set up also comes under this new rules. So as an effect of this, many young companies that have received notices from the IT department, that is income tax department, in the last few years will be relieved by the change in the rules. So this is retrospective. That means that it will not be applicable from present, but it shall also be applicable to the past cases. Now let us also understand what are the continuing concerns. So government has made certain relaxation in the regulations, but there are also other concerns with regard to startups. What are they? Firstly, those companies wishing to make use of the latest exemption will first have to be registered with the government as startups. So they have to mandatorily register with the government. And to be classified as a startup, the company needs to invest in at least rupees 10 lakh. And this requirement of investment is to prevent money laundering. So this will follow certain kind of bureaucratic delays or kind of red tapeism. So this can lead to delay. So we can say that only the angel investment part has been simplified, but other procedures for the startups are not yet simplified. So that also needs to be considered. Now again, another continuing concern is the evaluation of the fair market value. So we have seen that there is no proper criteria to evaluate or ascertain the fair market value. So the calculation methodology needs to be brought in. So unless the fair market value criteria has been properly decided, the evaluation of whether the share value is above or below the fair market value will not be possible, leading to further concerns with regard to angel taxation. And this is very important to deal with the arbitrary nature of the angel tax if the investor confidence has to be regained. So if the investor is confident in making investments, the startup ecosystem in India will prosper and it will create employment, both self-employment and jobs for the youth of the country. So this will also lead to increase in output, thereby increase in the GDP. So these concerns with the startup ecosystem in India needs to be addressed as early as possible. You can find the PDF of this lecture on my Facebook page, and for any queries regarding your UPSC preparations, you can get in touch with me on my Facebook page or you can email me at joyce.studyiq@gmail.com.